Hello and welcome to Money Talks, where our goal is pretty simple, just to make you richer. I'm Peter Switzer, and on tonight's show we have the CEO of Mortgage Choice, Sue Mitchell, to see how the Royal Commission will affect mortgage brokers. This could really affect the share price of Mortgage Choice as well. Then I've assembled the trio of 24/7 market watchers to assess how Bill Shorten will affect our investment, what looks hot and what does not. So let's get straight to it with Susan Mitchell, CEO of Mortgage Choice. I called you Sue in that introduction. I asked it before the show.
I'm going to be okay about that.
we always do that. Look,
yes.
You're in a really important position. The Royal Commission, did they get it wrong on mortgage brokers?
I think they got it wrong on mortgage brokers. They were focusing on the misbehaviour of banks, and I understand that 60% of the mortgages go through mortgage brokers, but there was no evidence of broker wrongdoing. There was nothing there to show that there had been complaints from the individuals, and mortgage brokers actually do more for consumers by offering competition, price discovery, and small business support. I think they got it wrong.
Yeah, I must admit, I remember reading a lawyer from Allen saying that she thought that Justice Hayne was out of touch with community expectations, but I thought it was a really nice way to say he just doesn't understand the importance of mortgage brokers in the lending scene.
I think that's probably true. Yeah. He doesn't understand just what they bring to the table.
Okay, so Labor has put on the table they will kill trail and give upfront commissions. What do you think of that suggestion by them?
I'm going to step back a second there and say, first of all, both Labor and Liberals have taken consumer pays off the table, and I think that's the first important step. Okay, that's the most important step. And then they've also talked about getting rid of trail. Trail has a bit of a bad name, and it's a bit of a shame because the reality is it's more of a deferred upfront. So you receive it upfront and then you receive an amount over time. And actually, that structure is really supportive of good consumer outcomes. The broker does not receive all his money if he's put the consumer in the wrong loan, if the loan goes into arrears, or if there's been any fraud committed. But to talk about what they have suggested, they have suggested 1.1 would go to the broker, but I think that's
1.1% of the loan.
Yes,
yeah?
Yes. So they have stayed actually with the value of the loan, which I think is appropriate. That takes away some of the bias. But they're intimating that that's what would actually go to the broker, not necessarily what would go to the aggregator. I think it's more of a placeholder to put in place to hopefully have further discussion. So it's a great start, but I think it's important that there should be some more discussion as to what happens next.
People listening wouldn't understand what you mean when you say aggregator.
Sorry, you're right. Excuse me. The broking industry is... The aggregator sits in between the broker and the bank.
So Mortgage Choice.
Mortgage Choice.
Aggregator.
Absolutely. So what happens is the banks, and then you have this aggregator in the middle, and then you have all these small businesses down below. And it's really important in that middle layer that you have enough value retained there, because they're introducing a lot of extra governance and compliance. And if they actually want that to work in the way that they want it to, you have to have this layer here to maintain and control that.
Well, when Mortgage Choice came on the scene in the early 90s, Peter Higgins...
25 years ago, yep.
Yeah, Peter Higgins came out from WA with a thing called a laptop, which was quite unusual at the time,
yes, with
13 lenders on it. So, in a sense, as an aggregator, that's what you brought to the table, and then mortgage brokers then, who signed up with you guys, could go to a borrower and say, look, you can go to one bank, or you can have a look at these 13 lenders here, and we'll try and get the best deal. That was the principle of the broking.
Absolutely, community. And those panels have grown to 25 and 30 lenders. That's how much the lending panels have grown outside of the Big Four.
Okay. You made reference to the fact that you don't know what's going to happen to the aggregators. Now, a lot of my viewers could be holding Mortgage Choice shares, and they want to know what you think is going to happen to the profitability given what's on the table.
Absolutely. So
you're CEO, so you should get
yes, I need to get this one right here. Yeah. I think the best thing for Mortgage Choice would be have a little bit more certainty to come into what is actually going to be paid to those brokers, which I think will come over time, and that's what we need. And once we get a little more certainty, we will be able to adjust and adapt our model to whatever comes. The reality is, if you go back to the basics, which is 60% of Australians use a broker to get their loan, and they have chosen that for themselves. There is a demand for that product, regardless of what the Royal Commission said. And I also, even though the property cycle right now is having a downturn, and we can talk about that later if you want to, but the reality is the long-term vision for the property market with the creation of households and the continued immigration is positive.
Okay. Have you talked to independent senators and alternative parties like the Greens to see what they think about what the Royal Commission recommended for brokers?
I have not spoken to some of those people. I've spoken to several of them, not too many, but what we have done is we have participated in the MFAA campaign, and all of the brokers are writing to all of their individual members and meeting people of both parties and actually encouraging their customers to do the same, because that's actually who they want to hear from right now. Yeah. They want to hear from their own constituents to see what they think. And I think the small businessmen going to their own member and explaining what this change is doing to them is the most powerful message. We do at our level talk to them as well, but the most powerful message is coming from the brokers themselves.
Okay, so what do you think is going to happen after the election?
Well, what I want to happen after the election is I would like to ask that whoever it is that the Australian public chooses, that there's consultation and there's a discussion so that we can continue to expand their understanding of what the broker actually does, and if they make a change too quickly, what it might actually do to the consumer. I'd also like for them to consider whether or not they have a hardwired date in there for taking away trail, July 2020. And the reality of that is very, very soon, because you almost have to have the legislation finished before Christmas. How does that work? That doesn't give much time if you're not starting till June or July. That's not much time for how important mortgage broking is in the home lending market. I think they need to give it a little more time.
Okay, and so in a perfect world, what would you like to see the arrangement to be?
I would love for them to not write off the current model. I would love for them to actually look at the current model or a variation of the current model alongside whatever other models that they would like to look at, and honestly consider them both and what's best for the consumer.
Yeah, one last quick one. The percentage of mortgage brokers who fell foul of the rules and the laws governing mortgage brokers in any one year. Big numbers or small numbers?
Tiny numbers.
Tiny numbers.
Tiny numbers.
Okay, Susan, nice to meet you.
Thank you. Appreciate it.
Time, didn't
you did. Thank you. I appreciate
Susan
that.
Mitchell, CEO of Mortgage Choice. Now, coming up, a trio of 24/7 market watchers: Julia Lee, Rudy Philippek Van Dyke, and Michael McCarthy on what stocks you should buy or sell ahead of a possible Prime Minister called Bill Shorten. Welcome back. I'm with my trio of investment experts, FN Arena's Rudy Philippek Van Dyke, Michael McCarthy from CNC Markets, and Julia Lee from Bill Direct. They're going to give us the stocks that we should sell in case of a Labor victory in this particular segment. I'm going to start with Julia because you've done a little bit of statistical work, but say it quickly because we've got to get some names.
Sure. Well, we know about the US election cycle, which is a 4-year cycle. So generally, year 1 and year 2 before the election underperform, year 3 and year 4 outperform.
Yep.
In Australia, it's a 3 cycle, so you've got the year before the election, year of the election, year after the election, and the best year is year 1, so before the election, and the year of the election. The worst consistently is year 3, so that would be 2020.
Okay, good point, good point. All right, so Rudy, let's go to you, and we are looking for the stocks people should be wary about if Bill Shorten should become Prime Minister and he gets his policy across the line, which he might not necessarily do.
Yes. Well, most people would think about the banks, and I would disagree with that view. I think the logical ones, which would be singled out, I think, are the health insurers and the private hospital operators. Yeah. But that is only one side of the coin. Yeah. Labour governments traditionally spend more money on education and on healthcare, so that might be the offset. Because maybe for people who haven't followed it, Labour has promised to keep cost increases for private health insurance at a maximum of 2%, which historically is very low for the sector. Yeah. And that's why a lot of people would advise to sell out of, for example,
NIB,
HealthScope, Ramsay Healthcare, NIB and Medibank Private. Yeah. But I would argue it is not that simple. There is an offset potentially in the fact that they might actually spend more money on healthcare, and then you actually want those companies.
Yeah. Yeah. Joel Fitzgibbon's brother wouldn't be happy about that, would he? Being the boss of NIB.
Well, I mean, those guys also obviously have now had quite some time to prepare as well. And my understanding is this year is the year of contract negotiations between the insurers and the private health. So they have negotiations going on. My understanding is also that the private health, not the private hospital operators, actually have the power to abandon the contract. And there is some quick calculation.
Sounds so capitalistic, doesn't it?
There is some calculations out there that if they do that, they would actually have the opportunity to increase costs by more than 2%. Not much though, but still by more. So it might be advantageous for them to abandon the contract.
Okay, let's go to the other winger in the team, Michael McCarthy. We're talking about stocks people should be worried about if Bill becomes Prime Minister.
Well, I think the focus on health that we have right now is appropriate, and I particularly don't like the lookout for the private health insurers, Medibank Private, NIB. I think they'll come under pressure. But I can tell you that traders are gearing up for this because there's likely to be increased volatility, and one of the things they're emphasising is a more nuanced approach. So, for example,
hang on, nuanced? I've got normal people out here now. What's that mean? Nuanced?
Granular? No, more particular, more specific. And so, for example, a trade that's being talked about at the moment is buy Ramsay Sell Estia. The idea being that Ramsay's offshore operations and what's perceived to be high quality operations will relatively outperform Estia. But being long Ramsay and short Estia gives you an offset in case the whole sector's hit. So you're taking a very granular approach, trying to pick the individual companies. And it's similar in the finance space. Vertically integrated models are likely to be hurt. Those big banks...
Example?
Those big banks... Well, AMP is the obvious one that comes straight to mind. But those big banks that are a little behind the game, like Westpac, for example, who haven't divested their wealth and have no plans to do so, might be hit harder than others that are further down the track, like ANZ and CBA. So once again, a pairs approach, long and short, so that if the whole sector gets hit, you've got an offset, but trying to pick the winners within the sectors rather than selling or buying the whole sector.
Julia?
Look, I think, first of all, the markets don't like uncertainty. So I think that the way the chips fall after the election is going to be important, whether there is a majority government or a minority government. The more stable the government, the better the market is going to be reacting. I also think that no government wants to preside over a recession. So I think we are going to see a bit of a, talking and then perhaps...
I mean, opposition party lying, and when they become in government, they become really responsible governors.
I did not say that, Peter.
Oh, I did. Okay.
So we could see, sell on the rumours, sort of buy on the facts.
Carbon tax in a government. You're gone.
So, and given that, the Australian economy is softening, I think fiscal spending is going to play a large part over the next 2 or 3 years. Yeah. So I would be looking for a setup for those trades where perhaps domestically focused sectors which are coming under pressure, like the discretionary spending space, we could see a bit of a rally after, we hear of a bit more spending, but that's a bit more confidence. That's
the good side. I want a negative. Like, for example, do we buy Stockland or do we sell Stockland? Because, with the negative gearing, new properties are going to be in, old properties out.
I think up to the election, we know that there's an impact on confidence, business confidence and consumer confidence. I mean, we've seen REA Group saying that 6 weeks before a federal election, they've seen an impact and they're budgeting for the same thing this year. So obviously REA Group, Domain have an impact, the discretionary retailers as part of that as well, if there's less property being moved. We've already spoken about the health insurance and the hospitals. And the other is domestic energy. Not only is it a federal election this year, but in New South Wales state election, an energy easy win card in terms of cutting costs, in terms of the energy bills to try and get some of those.
Are we buying energy or selling energy?
Selling energy.
Selling energy, really?
There's another one, and I was about to mention that governments, irrespective of which colour now, have now discovered the power of the Royal Commission. Yeah. And it's now a tool that I think will be more and more used. One suggestion being made by Credit Suisse this week is watch out for agricultural stocks. Murray-Darling Basin, water. If you're going to look into that, it may well be that we are going to clamp down on how the water is being used. Everyone in that region, from Instac Pivot to Costa Group to others, might be impacted there.
That's interesting. Maybe there'll be more class actions as well, some of those legal companies.
And people in agriculture areas are historically great Labor voters too, aren't they? Being a little cynical there, guys. All right, but I did throw one thing to you. In the real estate section, like if negative gearing is going to be an issue, is a company like Stockland going to be positively or negatively affected? Because they build new stuff, and under the negative gearing rules, new stuff will be demanded and older stuff won't be.
Yes.
please?
They're also moving away from owning subpar smaller shopping centres as well, and that, by the way, is a whole item on its own. But
a good move, do you think, Rudy?
Well, since they're moving away from it, I think the market will have a positive bias towards them.
Yeah.
But if they were holding on to it, then I think would be viewed negatively.
Okay, what about coal?
I want to buy a group like Venn. Venn have taken up all these rights in what are, at the moment, unminable gas fields. And I suspect reality's got a bite at some stage, right? So they've got Galilee Basin holding, they've got a Surat Basin holding, they've got an Otway Basin holding. They've done nothing with them yet.
Yeah.
But when gas prices boom and electricity prices go with them, the political pressure to do something about it, I think, will mean that gas is unlocked because it's the lower carbon, scalable energy.
You guys leave me down here. I want any negative stuff in this segment. One last one from you. Is there another area people need to be worried about?
I guess with the stock lending example, it's a two-edged sword because on one side, if you see property prices in general falling because of changes to negative gearing, even the new stuff is going to fall, even though Stockland might have an advantage. On the flip side, it sounds like there's lots of properties being moved in on the Gold Coast at the moment because grandfathering, getting in ahead of those proposed changes.
So in a sense you're saying they're buying and going to hold forever, and also a lot of retirees are probably looking at alternative sources of income. If franking credits are going to be affected, let's just get an apartment, they'll keep on giving me 4, 5 or 6%.
Well, that might also support the property sector too, because a lot of the dividends are unfranked already. Now, if franking's removed, suddenly they're going to be relatively much more attractive to those investors seeking income.
Okay, so we're going to go to a break now. When I come back, I'm going to try and force my guest to actually look for something positive. They'll probably come up with something negative. They don't listen to what I tell them what to do. But we'll be back in a moment. Welcome back to Money Talks. I'm Peter Switzer, and we're now looking for stocks that actually might do well if the Labor government wins the next election. With me is Julia Lee from Bell Direct, Rudy Philippek from FN Arena, and Michael McCarthy from CMC Markets. Let's kick off with you, Michael. You seem pretty keen to tell us about a stock that will do well. A trade. Well, Peter, because it depends what happens between now and the presumed election in May. We still don't know the timing of it. So you're doubting whether Bill Shorten will win this election?
I'm keeping a very one of the lessons of the last few years is around the world.
I think he's looking like Winks at the moment. And I taught Scott Morris. I like Scott to have a good chance, but at the moment, with everyone jumping off the ship like rats in a sinking boat, that really has made life hard for him.
Having declared firmly that Britain would vote to remain in the European Union, I am keeping an open mind.
Okay, fair enough.
So what I'm going to do is hang on to my portfolio, and depending where the market is, look at buying some put options on the index.
So
now,
explain to normal people what a put option is.
So put options go up in value when the share market falls. And you buy them over the index, and if your portfolio roughly matches the index, it gives a hedge. What you lose on your portfolio, you try and recoup by increasing the value of your put options.
Okay, so if you've got $1 million worth of stocks and you're long only on that, how much are you going to have to pay to get an option to cover off that million?
Roughly speaking, at current prices, you can get about 3 months cover for about 1.8% of the value of your portfolio. Okay. So if you've got $1 million, you've got to spend $18,000. Yes.
18.
So I guess a lot of people who made a lot of money to get to $1 million would think, well, I might take a punt on 18,000.
And that'll give you covered about 5% below the current market. So if there's a market crash, you might actually make more out of it. So it's the reason it's an attractive scheme for investors is all you can lose on the options that you buy is what you pay for them.
And where do you get the options like that, Michael?
From Bell Direct.
But not FN Arena. All right, let's go to you now, Julia. Let's talk about a stock that you think is going to do well because of Bill Shorten's got the keys to the lodge.
Well, election times means advertising times, so stocks like Nine Entertainment, Media, Southern Cross Media, I think will be a beneficiary. And look, there's been a lot of talk about reducing the private health insurance costs but increasing Medicare.
Yeah.
And that's great news for healthcare companies, so especially domestically focused ones like Helios as well as Sonic Healthcare might be winners from the overall spending in the healthcare sector.
Okay, Rudy?
Yeah, bad companies don't become better when the government spends some money. Anyway,
Oh, gee.
anyway, something to throw in very quickly, because you mentioned it before the break, coal.
Yeah.
I think the irony with a fossil fuel like coal is that the tide is turning against it,
Yeah.
but I think you will have a period in time when those who are still producing it will do well for a time, because you actually, what you're doing is you're cutting away the potential newcomers, and you're cutting out the smaller players, and the big guys who are producing coal will have a time for themselves. Yeah? So that's the irony
This
of
is
that.
a controversial call that Labor will be good for coal
Yes,
prices.
exactly. So
eh?
that's
could be the headline tomorrow.
The other thing is, which we haven't really mentioned, but traditionally Labour tends to be good for education,
Yeah.
and education is one of those sectors in the market. Unfortunately, a bit tainted years ago by Navitas, but even Navitas relatively does
tainted
well.
by Navitas?
Well, because Navitas was doing very well for a while, and
Lost a few
then it
contracts.
sort of fell out of favour and tainted that sector, because it's the market leader and always does that. But in the slipstream,
G8 hasn't helped either, has it? It's doing well now, but it's had a checkered.
yeah,
chart.
but that's for kiddies.
Yeah. Still education, mate.
It depends.
Yeah.
Some people say that Invocare is healthcare.
on that-
Really? Yeah.
but on that point, Labor is actually promising to do a lot for parents who've got kids in childcare.
And there's some state
That's true.
government
That's true.
initiatives as
And the
well.
state government's even thrown
Yes,
in New South
that's
Wales.
true.
I think it's quite limited though, because the state government is around community preschools, which locks out long daycare, which most people, I think, send their kids to. So
And again, the irony might be, because the sector has been marred by overpopulation of centres recently. Yeah? So if they feel there's more money coming from Labour, they might actually build more centres, and that's then bad for the sector overall.
Yeah, yeah. What about guys like Origin, those sorts of companies, AGL? Are they going to do well or worse under Labor? Because a lot of them are moving into renewables as well, and Labor's is a renewables outfit.
Renewables will be hurting at first. That's almost a given.
And I think initially the energy retailers are going to have problems. You know, we've already heard of measures coming through that will impact in terms of their revenue. And we know that people tend to be lazy, so you sort of tend to stay with your retailers. But now the longer you stay, you have to give a discount. And that's a cost that those energy retailers didn't have to pay before.
And throw in rocketing gas prices, as well as coal prices going up, and they're getting squeezed from both ends. The regulator's going to be pushing down on.
And then someone in Parliament might say, let's have a Senate inquiry in the sector, for example.
Do you think that'd be a likely...
I think if you get to a situation that the government can't come up with a quick solution, and the Vox Populi says, we want a solution...
OK, you also mentioned banks earlier. Do you think the banks are going to do well? Like, everyone thinks that Bill Shorten hates the big four banks. You think they might do OK?
He probably does, as does 60% of the population by now, but
only since the Royal Commission, because before the Royal Commission, like
yes, that's
80-odd% of Australians
That's
never
true.
complained about
but
the
now,
banks.
but now the whole image has changed.
Yeah, it's
now.
changed.
But also remember that the banks are an easy target. But once you're in power, the one thing you probably want to avoid is recession. So, you know, you are going to...
Well, and the other side of the coin is you can look very tough against the banks. Announcing a measure like $640 million, that's $160 million a year. CBA alone makes $10 billion. So you can look tough and get some big headlines around your initiatives without actually hurting the banks too badly. Okay. So they might get off a lot lighter than people think.
What I do believe is that the whole issue of franking, and then that's going to hurt I think that's been overblown, I think.
Okay.
Because for the simple reason also, as I always said to people, if you are looking to replace your dividends plus franking with another investment, then you have to scale up the risk so much that it's probably advisable not to do so. So, unfortunately, because the banks are such a good dividend payer internationally, you probably want to stick with it.
I read something quite brilliant today, which I actually wrote. And
oh, was that you?
Yes, mate. And the interesting thing is that Bill Shorten and his attack on franking credits will mean that people will start looking at alternative assets, which means some people will become more diversified which might actually be a good thing rather than a bad thing.
If they don't, yes, if they measure their risk while doing so, because if you make investment decisions purely based on tax, often you are with a subpar asset. And that has been proven time and time again. I mean, you go from trees to agricultural schemes and everything like that. And the banks have been, and Telstra have been those examples as well. And it's been like, the obvious statement to make is if you bought CSL in the late 90s and compare it with Telstra, you had more dividends from CSL than from Telstra, which is astonishing if you think about it. And nobody would buy CSL for the dividends.
Well, guys, we are out of time, but certainly none of you have actually said to me that we should be terribly scared about a Labor government.
We were getting there. We were getting there.
I think you should be more scared of a minority government. It would do more damage.
You're probably right. And also where you find that, as I say, very bullshit opposition parties often become quite reasonably responsible governments when they get into power. I think it's transfiguration. They discover stuff that they never knew when they weren't in government. Guys, thanks very much for coming on the program.
Thank you.
Rudy Philippek Van Dyke, Julia Lee and Michael McCarthy. So from my point of view, at the end of this show, one thing I want to point out is that before we go, a heads up about the Switzer Strategy Day conferences held in late April and early May in Sydney, Melbourne and Brisbane. I'll be joined by some of the best fund managers in the country, and the theme is investing in a politically challenging 2019. For details, go to switzerevent.com.au, and thanks for joining me. I'm Peter Switzer, and I'll see you next week.